Hello guys, welcome to this tutorial. In this tutorial, we are going to discuss about integrated reporting and sustainability accounting. Suppose imagine you are working in a global company where you have your net income is almost 50 million for the last year, but next day suppose your company stock price drops. These situations can happen. Like if we are performing better in terms of financially, but again the stock drop can happen, the company's value drop can happen. So how these things happening? So the financial aspects is only one single aspects of the business. There are many other factors also which has to consider while we are looking into success of a business. So there are various factors like the social factors, other environmental factors and cultural factors, human factors, all many factors which is affecting the actual result of the company. But if you are looking into the financial statement, it is revealing only the financial result of the company. So where the integrated reporting and sustainability accounting come into matter. So the integrated reporting meaning it's integrating many aspects of the business with the financial reporting. Like if you are normally reporting your financial results, you are integrating many other aspects as well, like how it's your human capital, how it's your social relationship, how it's your natural resources. So the integrated reporting is the process of communicating how organization strategy, governance and performance lead to creation of value over time. This is not only the finance, it's the integrated reporting is focusing on long term value creation over short term profit. Suppose let's look into some cases. If a company record high profit but it has 40% employee turnover ratio, is it truly performing? The simple answer is no. Why? Because the 40% of employee turnover ratio mean it's too high. That means our human intelligent capital, there is some serious concern with our human resources department or human capital management. So this has to be fixed to have a long term value creation over short term profit. As a management accountant, how do you put a dollar value on brand reputation or employee morale on budget? Can you put a value on brand reputation or employee morale on our financial budget? No. We cannot directly put a value on these non-financial metrics. Even these metrics are very crucial for long-term business success as well. So these are the non-financial factors which we cannot value in the budget. Thus focusing on environment, social and governance metrics conflict with the CFO's duty to maximize shareholders' wealth, or does it protect it? If you are looking into long term, short term gain you can make only with the profit. But if you want to make a real time long term value creation, you should focus on environmental factors, social factors, governance factors. All these factors has to be considered if you really want to make a long term value creation for your organization. So the integrated reporting is focused to create the long term value creation over short term gain or short term profit. So the Integrated Reporting Council IIRC framework 6 capitals that company used and affect. So these are the 6 important capital that you have to consider into integrated reporting. First thing is financial capital. That means what is fund available to use, what is your debt, what is your equity, what is your cash position. All these are this is the financial capital. Then the manufactured capital. Manufactured capital means the physical object like building, equipment, infrastructure. It's mainly your infrastructure. So your manufactured capital. Then your intellectual capital. What are your intellectual capital? Like patent, software, organization knowledge. These are the intellectual capital. These also you have to consider into integrated reporting. Then the human capital means people competency, capabilities, their experience, their exposure, all these factors has to be considered while looking into integrated reporting. Then the social relationship capital, the institutions and relationship with and between communities, stakeholders and brand reputation, these are the social and relationship capital. Then the natural capital, what are the natural capital available for the company to use, like environmental resources, water, land, minerals, air, these are the natural capital to consider. So, when it comes to integrated reporting, in the financial reporting you normally report only the financial resources only, but when it comes to integrated reporting you have to consider all these 6 capital or 6 categories of resources into your reporting frameworks. An integrated report explains the trade-off between these capital. For example, by using financial capital to automate factory to increase manufacturing capacity, maybe decrease human capital. That means these explain the trade-off between this capital also. Suppose if you have the financial capital, you can use to build the manufactured capital by using the financial capital. So obviously it will increase the human capital. That means the human resources can be decreased. So let's look into some corporate scenario. Consider a software firm spending 10 million on research and development. Traditional accounting treats this as an expense. Integrated reporting look deeper. It report on human capital and social capital that required to make research and development successful. So as a traditional accounting, this treat as an expense or capitalized based on the nature of the expenses. But the integrated reporting framework look this deeper. It report is into human capital and social capital. So the scenario 2, an oil company might report high quarterly earning, but under sustainability accounting, it must disclose standard asset, oil reserve that may never be extracted due to future carbon taxes. So these are the standard asset. If we are running an oil company, so this is a standard asset, that oil reserve that may never be extracted due to future carbon taxes. So this you have to report in your integrated reporting framework. So let's come to sustainability accounting. Sustainability accounting often follow triple bottom line framework. This is key rule of 3 for management accountant. The profit, the economic performance, like the return on equity, net profit, economic value added, these are the metrics in the profit or financial performance. Then the people or the social responsibility, that means the diversity ratios, safety incidents, fair wages, these are the social responsibilities. Then the planet, when it comes to planet or environment, carbon footprint, water recycled, waste diverted. So these are the 3 metrics or 3 triple bottom line framework that you have to use in the sustainability accounting. Then the sustainability accounting versus integrated reporting. Sustainability accounting focus especially in economic, social and governance metrics. Like we said, the financial performance, social performance and the environmental impact. This is the focus of sustainability reporting. But the integrated reporting is a broader concept. It connects the economic, social and governance data with the financial data to show how they affect the company's ability to create value. The integrated reporting is a more deeper and is extended version of sustainability reporting. It connects the integrated reporting, it's integrating the financial data with the sustainability report. The CMA exam often tests the guiding principle of integrated reporting. The most important is connectivity, how the different capital interact. That means if you look into you have the financial capital or you have the financial capital, you can use that financial capital to build your human capital or intellectual capital. So, this is the connectivity of information, how you can use one capital to build the another capital. Then the materiality. Materiality is a matter. Materiality is a matter in the integrated reporting. It matter anything that substantially affect the organizational ability to create value in the short term, medium or long term. That is matter in the integrated reporting. The materiality is the matter in the integrated reporting. So, just summarizing what we have discussed today, the integrated reporting, it provides a holistic view of company strategy and future viability. The traditional reporting is solely focused on the financial impacts, but the integrated reporting is provide a holistic view of how a company strategy and how integrated reporting provide a holistic view of a company strategy and future viability. The 6 capitals are the essential input: financial capital, manufactured, intellectual, human, social and natural. These are the 6 capital that you have to report in the integrated reporting. Then when it comes to integrated reporting, the value creation is the core purpose. It is not about current years or a short term profit or short term gain. Then the triple bottom line measure of success by profit, people and planet. These are the triple bottom line measure to measure the sustainability accounting. Even as a management account, you are responsible to gather the non-financial data and linking the non-financial data with the financial outcome as well. So, let us move into multiple choice question today. Question 1. A company invests heavily in a new employee training program and state of art wellness center. Under integrated reporting framework, this would most likely represent a conversion of option 1 financial capital to human capital, option B manufactured capital to social capital, option C human capital to intellectual capital, option D social capital to financial capital. That means this is a building a facility for human capital. So, the option A is the right answer. It is using financial capital to build the human capital. So, let us look into question number 2. Which of the following is a primary objective of sustainability accounting and the triple bottom line approach? Option A, to prioritize environmental goals over financial profitability. Option B, to provide a standardized format for reporting only to internal stakeholders. Option C, to measure company's performance in terms of economic, social and environmental impact. Option D, to replace the need of traditional financial statement like the income statement. So, here option C is the right answer because it measures the company's profit performance in terms of economic, social and environmental impact. The sustainability accounting considering the economic impact, social impact and environmental impact as well. So, this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.